Well, we've got the Federal Reserve to thank for the market's stellar performance. Their zero interest rate policies, compounded exponentially by their quantitative easing programs, lifted stocks as planned in what the Fed calls the wealth effect. The wealth effect is, of course, the Fed's articulated plan to lift stocks, to lift the whole stock market, so people feel better about the economy, about the future, and feel so wealthy they ramp up consumption. It's a neat magic trick that's worked so far pretty well. That is, if you happen to be in stocks. The problem is, the market doesn't always follow some yellow brick road. It has, but once again, we're facing headwinds, and we'll see if Mr. Market can steady himself once more, or whether we'll feel the chill of the long-awaited correction. Well, first of all, there's the normalization of interest rates, meaning the Federal Reserve's done buying bonds and says it's going to raise interest rates this year. That could be a problem. If rates rise, that may put a damper on some buybacks, which have been boosting stock prices. There's also the China question. Will it or won't it continue to be the global engine extraordinaire? If China slips, if it slips badly, which it easily could, that would be like a wrecking ball coming through the Fed's wealth effect wall. We're still also looking at Greece and Europe and all their debts. They're not just going to vanish. The same is true for Japan and China. And if you look at Puerto Rico as a proxy for what can happen stateside, there's that debt bomb too. And there's more. Yes, there will be signs. How the markets react to any Federal Reserve interest rate hikes will be a first signal. Investors also have to watch Europe and how it deals with Greece and the other union members and their huge debts. China, however, should be front and center for every investor. If China starts crashing, everyone across the globe better take their profits and ride out that storm. Or better yet, short the markets like we're going to do. Like we do a lot when there are downside opportunities. You know, you can always make more money, a lot of money, quickly when markets tank, because they always go down faster than they go up. Yes, generally speaking, first of all, you've got to be in it to win it. That's my saying. I love that, and it's absolutely true. So stay invested, but diversify and take profits. You always have to have an exit plan, always, which has to include stop-loss orders being in place at all times. You can always get back into your stocks, especially if some panic passes and the coast looks clear again. You've got to be in it to win it. So get back in, have your exit plan in place. It sounds easy, and it is. You just have to do it. It's sitting on the sidelines that's going to kill you.